Welcome back, everyone. It's your host here with another episode of the How To Channel. Today, we're diving deep into a topic that's way more important than you might think: credit scores. See, your credit score is like your financial GPA, and let's be real, nobody wants a bad GPA, right? A good credit score is your golden ticket to unlocking all the good stuff in life: lower interest rates on loans, easier approvals for apartments, even better car insurance rates. Who wouldn't want a piece of that action? But here's the catch. Most people don't even know their credit score, let alone how to improve it. That's where we come in. In this video, I'm breaking down everything you need to know about credit scores in a way that's actually understandable. No more confusing jargon, no more financial mumbo-jumbo, just straight up actionable advice. We're talking step-by-step strategies to boost your score, common mistakes to avoid, and insider tips to get you on the fast track to financial freedom. So, if you're ready to take control of your finances and unlock a world of possibilities, buckle up, hit that like button, and subscribe to the channel for more awesome how-to content. All right, folks, let's break down this whole credit score thing. Imagine it like this. Every time you borrow money, use a credit card, or even pay your bills, it gets reported to these companies called credit bureaus. These bureaus then use that information to create your credit report, which is basically a detailed history of your financial behavior. Now here's where the credit score comes in. It's a 3-digit number, usually between 300 and 850, that summarizes all the information in your credit report. The higher the score, the better your credit worthiness, meaning lenders see you as less risky and more likely to repay your debts. Now, you might be wondering, what exactly goes into calculating this magical number? Well, the most commonly used credit score is the FICO score, developed by the Fair Isaac Corporation. This score takes into account 5 key factors: your payment history, 35%, amounts owed, 30%, length of credit history, 15%, credit mix, 10%, and new credit, 10%. Each of these factors plays a role in determining your overall credit worthiness. Think of it like this. Your payment history is like showing up on time for work every day. Amounts owed is like how much you're spending compared to how much you earn. So why should you even care about all of this? Well, my friend, a good credit score is your ticket to financial freedom. It can save you thousands of dollars in interest payments over your lifetime, make it easier to rent an apartment or buy a car, and even help you qualify for lower insurance premiums. Imagine walking into a bank, asking for a loan, and getting the best possible interest rate just because you have a killer credit score. That's the power of a good financial reputation. On the flip side, a low credit score can hold you back from achieving your financial goals. So, whether you're planning to buy a house, start a business, or just want to secure your financial future, a good credit score is essential. All right, now that you know what a credit score is and why it matters, let's talk about how to actually check your credit report. You can get a free copy of your credit report from each of the 3 major credit bureaus: Equifax, Experian, and TransUnion, once every 12 months. You can access your reports through a website called annualcreditreport.com, which is the only website authorized by federal law to provide free credit reports. Now, you might be tempted to just glance over your report, but trust me, you want to take your time and really comb through it. So you've got your credit report in hand, now what? Don't worry, it's not as complicated as it looks. Your credit report is basically a timeline of your credit history, showing all your open and closed accounts, payment history, and any outstanding debts. The first thing you want to check is for accuracy. Make sure all the personal information like your name, address, and social security number is correct. Then go through each account listed and verify that the information matches your records. Look out for any errors, like incorrect balances, missed payments that you actually made, or even accounts that don't belong to you. You'd be surprised how often these mistakes happen. And listen, even small errors can have a big impact on your score, so you gotta be vigilant. Section 3, Credit Report Disputes. Channel your inner warrior. Now, here's the empowering part. If you find any errors on your credit report, you have the right to dispute them. You can file a dispute online, by mail, or even by phone. Just provide the credit bureau with as much documentation as possible to support your claim, like payment records or statements from your creditors. Once you file a dispute, the credit bureau has to investigate it within 30 days, and they have to get back to you with their findings. If they find an error, they have to correct it, which can give your credit score a nice little boost. Section 1. Payment history, the holy grail of credit scores. All right, let's talk about the MVP of your credit score payment history. This bad boy makes up a whopping 35% of your FICO score, so if you want to boost your score fast, this is where you need to focus. Think of it like this. Your payment history is like your track record for keeping promises. Every time you make a payment on time, you're basically telling lenders, hey, I'm good for my word. You can trust me with your money. On the flip side, late payments are like broken promises, and they can seriously damage your credit score. Section 2. Mastering on-time payments, your secret weapon. In today's digital age, there's really no excuse for missing a payment. We've got reminders, alerts, autopay, you name it. It's like having a personal assistant for your bills. First things first, make a list of all your bills, including due dates and minimum payments. You can use a good old-fashioned planner, a spreadsheet, or even a budgeting app. Whatever works for you. Once you've got your list, set up reminders. Most banks and online bill pay services offer email or text message reminders a few days before your payment is due. Section 3. Late payments, the bane of your credit existence. Now, I know what you're thinking, but Trevor, what if I mess up and make a late payment? Is my credit doomed forever? Relax, my friend. It's not the end of the world. Life happens, we get busy, sometimes things slip our minds. But the key is to address the situation as soon as possible. If you realize you've missed a payment, contact your creditor right away. Explain the situation and see if they're willing to waive the late fee or work out a payment plan. You'd be surprised how often creditors are willing to be understanding, especially if you've got a good track record. Now, if you've got a history of late payments, it's gonna take some time and effort to rebuild your credit. Section 1. Credit utilization, the balancing act. All right, let's talk about credit cards, shall we? Those little plastic rectangles that can either be your best friend or your worst enemy. It all comes down to how you use them. You see, one of the biggest factors affecting your credit score is something called credit utilization. It's a fancy term for how much of your available credit you're actually using. Think of it like this. You've got a credit card with a $10,000 limit. Section 2. Taming your credit cards. Less is more. So, what's the magic number when it comes to credit utilization? Well, experts recommend keeping your credit utilization below 30%. That means if you've got that $10,000 credit limit, you should try to keep your balance below $3,000. Think of it like this. You're showing lenders you can handle credit responsibly without going overboard. You're like the Goldilocks of credit utilization. Not too high, not too low, just right. Section 3. The art of paying off debt. Strategic moves. Now here's where things get interesting. Let's say you're trying to pay down your credit card debt and boost your score. Should you focus on paying off the card with the highest balance first, or the one with the highest interest rate? This is a question that keeps financial gurus up at night. But here's the deal. Both strategies have their pros and cons. Paying off the card with the highest balance first can give you a quicker sense of progress and free up more of your credit limit, which can improve your credit utilization. On the other hand, paying off the card with the highest interest rate first will save you more money in the long run. Section 4. Closing accounts. Proceed with caution. Now, you might be thinking, hey, if I close some of my credit cards, won't that reduce my overall credit limit and improve my utilization? Well, not so fast, my friend. Closing credit card accounts can actually hurt your credit score, especially if you're closing older accounts. You see, the length of your credit history is another important factor in your score. Closing older accounts can shorten your average credit history length, which can make you look less experienced to lenders. Plus, if you close an account with a high credit limit, it can actually increase your credit utilization, even if your overall balance stays the same. So, before you go on a credit card closing spree, think carefully about the potential impact on your score. Section 1. The new credit trap, tread carefully. So we've talked about paying your bills on time and managing your credit cards like a boss. But here's another piece of the credit score puzzle. New credit inquiries. Now you might be thinking, inquiries? What's that all about? Well, every time you apply for a loan, credit card, or even rent an apartment, the lender or landlord will typically check your credit report. This is called a credit inquiry. Think of it like this. Every time someone checks your credit, it's like leaving a little footprint on your report. Now, a few footprints here and there aren't a big deal, but if you've got a whole stampede of inquiries on your report, it can raise red flags for lenders. Why? Because it can make you look desperate for credit, like you're trying to borrow money from every bank in town, and that, my friends, can make lenders nervous. Now, before you swear to never apply for credit again, let's break down the two types of inquiries. Hard inquiries and soft inquiries. Hard inquiries are the ones that really matter for your credit score. These are the inquiries that happen when you apply for new credit, like a credit card, loan, or mortgage. Hard inquiries can ding your credit score by a few points, especially if you have a lot of them in a short period. But don't stress too much. These dings are usually temporary, and your score will bounce back as long as you manage your credit responsibly. Soft inquiries, on the other hand, are like stealthy ninjas. They don't affect your credit score at all. These inquiries happen when you check your own credit report, when a potential employer runs a background check, or when you're pre-approved for a credit card offer. So, what's the moral of the story here? Well, it's all about balance, my friends. Building a good credit history takes time and patience. It's like growing a garden. You can't just plant a bunch of seeds and expect them to bloom overnight. If you're just starting out and you don't have much credit history, it's important to build credit responsibly. Don't go crazy applying for every credit card offer that comes your way. Instead, start small and gradually build up your credit over time. Consider getting a secured credit card, which requires a security deposit that acts as your credit limit. Or ask a trusted family member or friend to add you as an authorized user on their credit card. The key is to show lenders that you can handle credit responsibly by making your payments on time and keeping your balances low. Remember, slow and steady wins the credit score race. Look, I get it. This whole credit score thing can seem overwhelming, but trust me, it doesn't have to be. The most important thing is to be proactive and take control of your financial future. Remember, your credit score is a reflection of your financial habits. By making smart choices today, you can set yourself up for a brighter financial tomorrow. And hey, if you slip up along the way, don't beat yourself up about it. We're all human. We all make mistakes. The key is to learn from those mistakes and get back on track. So go out there, check your credit report, make a plan, and start building the credit score of your dreams. And hey, while you're at it, hit that like button and subscribe to the channel for more awesome how-to content. So there you have it, folks. The inside scoop on credit scores, broken down in a way that even your grandma could understand. Remember, your credit score is more than just a number. It's your financial passport to the world. A good credit score is your ticket to unlocking lower interest rates on loans, snagging that dream apartment, and even scoring sweet deals on car insurance. It's like having a VIP pass to the world of financial freedom. Building a solid credit history takes time and effort, but trust me, it's worth it. Start by checking your credit report, disputing any errors, and then focus on making those payments on time like a boss. Keep your credit card balances in check, and don't go applying for credit like it's going out of style. Remember, your credit score is a journey, not a sprint. There will be bumps in the road, but as long as you stay informed, stay disciplined, and stay positive, you'll reach your financial destination. Now go out there, take control of your credit, and watch your financial dreams take flight. And hey, before you bounce, don't forget to show some love by smashing that like button and subscribing to the How To channel for more awesome tips and tricks to make your life easier and your wallet happier. Until next time, stay savvy, my friends.